Good morning, folks. It's Monday, May 18th. It's the day the bridge opens for all you people that live here in Monmouth County. The bridge to Red Bank opens today from West Front Street. It's a wonderful thing. My name is David Berkowitz. I'm the Chief Investment Officer at ValueAligned Partners. My friends call me Burke, and so this is Burke's update as of the end of Friday, May 15th, 2015. Our year-to-date performance is, in the hedge fund, we're up 4.8% against other stock hedge funds that are up 3.4%. In the ValueAligned model portfolio, we're up 7.1%, and the S&P 500 index is up 3.9%. Now, there's something I want to talk about today, and that's called tactical allocation. It's one way that we manage risk in both the long-only ValueAligned model portfolio and in the hedge fund. And let me tell you what Investopedia says about tactical allocation. Sometimes you see it TAC, but I'm going to call it tactical allocation. An active management portfolio strategy that rebalances the percentage of assets held in various categories in order to take advantage of market pricing anomalies. That means prices that are either too high or too low according to some kind of valuation model. Strong market sectors, that's ones that have momentum. I mean, people are pouring money into the particular sector. So either we allocate money into that sector and go along for the ride, or we think it's at the end of that cycle and so we go against it and we take money out of the sector. And we worry about the risky bubbly sectors, things the way housing was, the way real estate was before the crash, the way bonds are now, we think. Those are the ways that we can have one overall strategy, but within that strategy we can make some determinations about the prices and the values of certain sectors, and we move money around to make sure that we can take advantage of that and avoid some risks as well. So the typical way that Wall Street and academia and the rest of the world does tactical allocation, and again that's one way to measure risk and manage risk, is that they take a whole slew of investable categories. They take U.S. stocks, international stocks, emerging market stocks, bonds, cash, commodities, gold, and there's even a lot of real estate's not on here, but real estate would be another one. My point is you try to take, they tell you to diversify a portfolio, and in my estimation they do that to cover their own ass, because people that are recommending things, as long as they have it spread out around everything and everybody does the same thing, nobody can get sued for having a tweak here or a tweak there, but everybody is quote-unquote diversified. But let's take a look at this a little bit more closely. What this means is that 30% of our portfolio, let's say we start out, we give our portfolio manager $500,000 in cash. And maybe that's what we had in our 401k, and then we transfer our 401k over to a rollover IRA, and then the new manager or the new broker is going to manage that money. So we got 30, he says this is our allocation. This is the way we stand right now. We're going to put 30% of it in U.S. stocks. It could be stock funds or it could be stocks individually, but 30% in U.S. stocks, 15% in international stocks, 5% in emerging market stocks, and then we're going to have 30% of the money are going to be in bonds. And the reason why we have 30% in bonds is because you happen to be 30 years old or 40 years old, and this is what our guru tells us, that you should have at least that much in bonds. We have 5% in cash, we have 5% in commodities, and we have 10% in gold, because everybody knows that gold is a hedge against inflation, and it should be going up, or at least we can have 10% of our portfolio not earning any money, but in case the world blows up, we can have the gold. Now, I want to simplify things. You saw all those different stocks, and within those investments, there's subcategories. What I want to do for you is educate you to understand that there's really only three kinds of investments. There's the fixed income investment, where over time you get a fixed payment in dollars over time. It's like a bond. Say a bond, say you put $100,000 into a bond, and the bond is going to pay you 10% interest every year. That means you're going to get $10,000 every year. But for the length of the bond, let's say the length of the bond is 10 years. So every year you're going to get $10,000 in paper dollars. In currency units, you're going to get $10,000. You're going to get $10,000 this year, and in the last year you're going to get $10,000, and you're going to get all your money back. So you're going to get $100,000 in 10 years plus the $10,000 of income, but it's still the same. There's no accounting for inflation with a fixed income. So that's one way to do it, and that's the one that everybody tells us we need to have in our portfolios when we get older, because we need fixed income because it's less volatile than everything else. And then there's no income investments, and no income investments are things like commodities and gold and things and market and art and things like that. Those are really not investments in my mind, but we have to put them on here because the rest of the world thinks of them as investments. What that is a no income investment. That means over time it pays you nothing. So the only thing we're hoping is that that investment that we paid X for, that some other person will pay X plus something in the future for it. Or we hope that it holds its value in the case of Armageddon. Then the only investments that really make any sense for anybody that cares about a 30 to 40 year accumulation phase and investing phase, so you can invest into retirement, are rising income investments. And there's only two types of rising income investments that you need to worry about. One is real estate, that is rental real estate, where the rents rise over time. They either go tied to inflation, or sometimes they're tied to the availability of the rental property stock that's in the particular area. But either way, typically rents are rising, and in that type of real estate, it's like a business. That's a real estate that has rising income. The other one, of course, is businesses, companies. In general, companies, especially the successful ones or the great ones, have over time their incomes rise. And because their incomes rise, their dividends rise, or their potential for dividends rise. And so we want to own businesses and or shares of those businesses, which in fact are stocks of great companies. And that's what our asset allocation model is centered around. We are either in rising income investments, in our case, stocks of great companies, or we're in cash. So I move back and forth between cash and stocks of great companies. My overall strategy is to always be 100% invested in stocks of great companies. That's our strategy. But on a tactical basis, sometimes we'll go to cash. Sometimes we'll have enough cash because we expect that we have a short-term or medium-term correction in the market where we can pick up some stocks of great companies at great bargain prices. So that's the allocation. You see, we either have 100%, 99% in stocks of great companies, or cash. So we go back and forth between that and cash. Forget all the other stuff. We want to have rising income investments for the long haul, and in the intermediate term, to manage our risk, we tactically allocate between those companies and cash. So cash gets bigger or smaller depending on what our model tells us. And I know this is not conventional wisdom. So Warren Buffett, in this year's Berkshire Hathaway annual report, wrote the following: the unconventional but inescapable conclusion to be drawn from the past 50 years is that it has been far safer to invest in a diversified collection of American businesses than to invest in securities, treasuries, for example, whose values have been tied to American currency. That's his fancy way of saying it's fixed income. That you're going to get currency units that are fixed back in time. Then he goes on to write, that was also true in the preceding half century. a period including the Great Depression and 2 world wars. Investors should heed this history. To one degree or another, it is almost certain to be repeated during the next century. So what he's basically saying is there, buy stocks, buy a diversified portfolio of stocks, don't buy bonds, and certainly don't buy no income investments that are really just speculations like gold and art and coins and stuff like that. Then he goes on, stock prices will always be far more volatile, meaning they go up and down and wiggle all around in the short term, than cash equivalent types of holdings. Over the long term, however, currency denominated instruments like bonds or bank deposits, they are riskier investments. Here's the Sage of Omaha telling us that bonds are riskier, far riskier investments than widely diversified stock portfolios, stocks of great companies, that are bought over time and that are owned in a manner invoking only token fees and commissions. That lesson has not customarily been taught in business schools, where volatility is almost, that's the wiggles that go up and down, almost universally used as a proxy for risk. Though this pedagogic assumption makes for easy teaching, it is dead wrong. It's easy for everybody to plug into a formula, that's what Buffett is saying here, and it's easy for them to say and define risk as some mathematical equation that goes up and down a lot. That's called volatility. And he says volatility is far from synonymous with risk. Popular formulas that equate the two terms lead students, investors, and CEOs astray. And how? Boy, is that a mouthful. That in a 2 paragraph sums up what is wrong with what's called modern portfolio theory, the stuff that has been taught in business schools for the last 30 years, and that is that you can't beat the market, and beating the market is somehow a goal in mind. You can't do that because stocks in the short term go up and down a lot more than bonds go up and down a lot more, and certainly go up and down more than cash. But that's in the short term. And none of us listening to this call should be investing for the short term or intermediate term. So there it is. So how do we do that? How do I decide that I should have 80% in stocks of great companies and 20% in cash? How should I decide I should only be exposed 80% to the stock market short-term variations? Well, this is how I decide. I use Hayes Advisory's model. I've been using it for 12 years now. And basically what that is it's numerous market indicators that are in 3 main categories. One is psychology, and that's how investors feel, whether they're, basically we measure by their behavior whether investors are greedier, and if they're greedier, that's a sell signal for us because we're contrarians. Or if they're fearful, that's great for us too, because if it's more fearful, more cautious, that means it's time to put our cash to work. So we're more bullish when investors are fearful. We're more bearish when investors are feeling happy and feeling like there are no risks. That's when there are too many risks. The second category is monetary conditions, and that's basically what the Fed is doing, what liquidity is like in the stock, in the markets in general, how well corporations are able to borrow and at what price, and how that all impacts the market. So we also measure what that's doing. And then there's overall general market valuation, and that's just generally how stocks are priced relative to what we think is the value of the stock market in whole. Now, after the crash, we, simultaneously with Hayes, it appears, created a fourth leg, which is the market trend analyzer. We call it the Rapidan market trend analyzer. It's a tool that utilizes moving averages of stock index prices and other price movements to recommend defensive moves. And all that, that's a mouthful for us saying that had we had this in play during the crash, we would have avoided something like 35 percentage points decline. We would have sold everything and gone to cash after 15 percentage points down. I mean, we still would have had losses from the top in October of 2007, but we would have basically missed the big decline. And that's supposed to be an early warning signal, even when everything up here, all these signals tell us that it's a buy. The trend analyzer tells us that there's something more systematic involved, like a Lehman bankruptcy is on the way, or something is that grave that we just got to get out of the market and be in cash. And here's one of the indicators that we're looking at closely over the last 2 years to help us determine whether we should shrink the amount of cash that we have, or whether we invest it in the stock market, that is, buy low, or it's time to get more cautious and to shave a little bit off of our investment to have a little powder dry for later. So you can see what this measures over time. This is a 2-year chart, and what we're looking at is there are 500 stocks in the S&P 500, and we're measuring out of those 500 how many at any given day what percentage of any given day are trading above their 50-day moving average, which is a typical moving average in analytical land that lets us measure whether there's a short-term or intermediate trend. So if stocks are trading below their 50-day moving average, typically that could signal a trend reversal, meaning if stocks had gone up, well, now they've gone down below the 50-day. If they persist down there, then it very well could be that we have a trend reversal. But if we think that the stock market is in a trend that is up, and in the short term we get very like below, here's like the 40% line right here. If below 40% of the stocks in the S&P 500 are trading above its 50-day moving average, we'll get readings below this line. And you can see those are like warning signals to us. But when it gets to be green, the 30% level and below that, that's when we buy. So you can see in October of last year, we got a huge buy signal. It's one of the best buy signals on this indicator that we got in a very long time, and we plowed back into stocks at that moment, and it really saved our year last year because we were defensive coming into that because we had just invested a bunch of stocks there, and then all of a sudden stocks started going down again. So we lost a good deal of our performance for the year. But this saved us because this told us, no, we made an indication that the primary trend was still up, and that right now we're having a temporary fear setback in October, and we needed to put all our cash back to work, and we did. We made a lot of money. And then somewhere at the end of the year, we got more cautious because we had these red signals up here. We got more cautious, so we went to 20% cash, only 80% exposed to the market, and we've been there ever since. So we're still 80-20, just like Hayes' model says, but we've been there ever 20, and this has been the instrument that I've been using to fly our plane lately. And you can see it's been coming down over this year so far, year to date, but it never quite got below 40, and it certainly didn't get to 30. So we never invested the cash. I got to tell you, I really wanted to during here, but I just didn't get there. So even though my emotions told me it was time to invest, I didn't do it. And we stayed the course. We still had a really good February. And since then, we've been up and down and moderately up, and we just made new highs. And you can see that only 62 or 63% of the stocks in the S&P 500 closed above their own 50-day moving averages on Friday. So we're right there. Here's a downtrend line. And you can see that people are getting a little bit more cautious. Now, the question remains, are we going to be resolved to the upside, or are we going to resolve to the downside? And that's fine with me. If we're going to get resolved to the upside and I still have 20% cash, I can still wait for the correction. Because that's what my models and my instrument panel tells me to do, and that's what we will do. So we're still hedging our gains with cash. Stocks are a bit overvalued, but there are still opportunities. Monetary policy is really the only thing that's holding up the market right now. And that's why you can see all the focus. There's so much focus on when the Fed is going to start raising interest rates from 0 to 0.25% or whatever they're going to raise it to. I think the market is misplaced in this looking at this, but anyway, it just goes to show you that it's liquidity, it's monetary policy that has been supporting the bull market really for the last year, and that's why we've had so much of our money in cash as opposed to being all in the market. And we're still waiting for lower prices to invest that 20% cash. Well, that's it for now. Go to www.valuealigned.com and check out some changes. We're going to make some changes over the next couple of months. So for periodically go back and check there, and you get to see my smiling face in action in some videos that we have linked there. And also, of course, there's my blog that talks about investing, and hopefully I try to make it in simple terms. And just like we try to make our investment process in simple terms. You know, forget about what everybody's telling you. There's only 3 types of investments. There's not thousands and thousands of investments. There's only 3 types of investments. And all we have to worry about is our allocation between businesses, stocks of great companies, shares of great companies, and cash at any given time. And that's what we do.